The number one question I get every single day is this: why is XRP not moving the way it should be moving right now, given everything that is being quietly built underneath it? And here's the thing: while your timeline has been absolutely flooded with news about other projects, about ETF inflows into alternative assets, about FedEx and supply chains and cross-chain bridges and digital product passports, I want you to understand something. Every single one of those developments is pointing a flashing arrow directly at XRP, and almost nobody is connecting the dots. What I'm about to show you is not being discussed the way it should be. The world is missing the signal, not because it isn't there, because most people are looking in exactly the wrong direction. Let's fix that right now. Welcome back. I am the Calm Analyst. This channel exists for one reason: to cut through the noise, the hype, and the emotional chaos of this market and go straight to structure, data, and logic. Today, we are decoding what the last 30 days of news that appears to be about other projects, actually reveals about XRP's position in the global financial infrastructure stack. Let's get into it. Let me start with a hard truth. Most people watching this market are treating it like a horse race. They're watching which coin is up, which ETF is getting inflows, which blockchain landed a partnership this week. And that is exactly how you miss what's actually happening. Because what's actually happening isn't about any single project. It's about a global infrastructure layer being constructed, piece by piece, in plain sight. And XRP is not a participant in that construction. XRP is the settlement rail it is being built on top of. Think about that distinction carefully, because it matters enormously. Here's what I mean. Over the past 30 days, we've seen a cascade of announcements from the enterprise world that, on the surface, appear to be about distributed ledger technology broadly. FedEx joins a blockchain council to address trusted digital infrastructure for global shipments. The European Union announces a mandate that every product sold into its market must carry a digital product passport by 2027, a verified, on-chain record of origin, materials, and full life cycle. PwC is now partnering on enterprise-grade implementations. The DTCC, the Depository Trust and Clearing Corporation, the institution that clears and settles virtually every stock trade in the United States, has published patents referencing digital liquidity tokens, hierarchical wallet infrastructure, and tokenized real-world assets. Now, here's the question the retail crowd isn't asking. When these trillion-dollar institutions digitize their supply chains, their trade documents, their product passports, their clearing rails, what do they settle in? What is the bridge currency? What moves the value from point A to point B without a correspondent bank eating 3 to 5 days and 3%? That is not a rhetorical question. That is the question that has a very specific answer. And the answer is not going to be 17 different siloed blockchain tokens. The answer is going to be a neutral, liquid, institutionally approved bridge asset that was purpose-built for exactly this function. You see, retail investors look at XRP and see a price on a chart. They see market cap and daily volume and whether it's up or down on a given Tuesday. But financial institutions, the architects of the next financial system, they look at XRP and see the plumbing. They see a token that already has a proven track record in live cross-border settlement, a fixed supply that can be modeled with certainty, regulatory engagement that no other asset in this space can match, a ledger that has never gone down, never been hacked, and settles in 3 to 5 seconds. This is not a promise. This is a track record. And the world is quietly, very quietly, building its next infrastructure layer with that track record in mind. So when you see FedEx talking about trust at the speed of data, when you see the DTCC filing patents around digital liquidity tokens, when you see global regulatory bodies mandating on-chain provenance by 2027, understand what you are actually watching. You are watching the demand side of the XRP equation being constructed in real time. The supply side? That story is even more interesting, and we are going to get to it. Let's do the math that the crowd is ignoring. Think about what we know. Cross-border payments globally represent approximately $150 trillion annually. Foreign exchange markets turn over $7.5 trillion every single day. The derivatives market, the contracts, the swaps, the hedges that sit on top of the global financial system, is conservatively estimated at $1.2 quadrillion in notional value. Now, here is the math that doesn't get discussed. The current correspondent banking system requires something called Nostro and Vostro accounts. These are pre-funded accounts that banks hold in foreign currencies so they can execute cross-border transactions without waiting. The capital locked in these accounts globally sits at approximately $27 trillion. $27 trillion, sitting completely idle, doing nothing, just waiting to be used as a friction reducer for a broken system. XRP was engineered to eliminate that $27 trillion problem. When you use XRP as a bridge currency, a bank in Japan does not need to pre-fund a dollar account in New York. XRP steps in, converts, settles, converts back in 3 to 5 seconds. The capital is freed, the friction is gone. Now let's talk about supply mechanics, because this is where the math gets genuinely uncomfortable for the people who are not paying attention. XRP has a fixed total supply of 100 billion tokens. Not inflationary, not mintable, fixed. Of that, roughly 55 to 57 billion are currently in circulation. The rest sits in escrow, released on a known, predictable schedule, and the majority of what is released is relocked. Now here's the critical variable: exchange reserves. On-chain data shows exchange reserves for XRP declining consistently over the past several quarters. Tokens are moving off exchanges. They are moving into cold storage, into institutional custody, into positions that are not going to reappear on a Coinbase order book for a 10% trade. When an institutional custodian takes XRP into a multi-signature vault as part of a treasury management strategy or a settlement reserve, that supply does not return to market at $3. It does not return at $10. It returns when the institution decides its liquidity requirements have changed, which, in enterprise finance, could be years. So let me lay this out cleanly. You have demand being structurally constructed through global digital trade mandates, DTCC infrastructure plays, cross-border settlement modernization, institutional ETF vehicles now live and accumulating, and an entire EU regulatory framework requiring on-chain provenance by 2027. You have supply being quietly, systematically reduced through institutional accumulation, custody lockup, and on-chain data showing exchange reserves at multi-year lows. And you have a fixed total supply of 100 billion with no emergency print button. This isn't a prediction, this is a requirement. When the institutional liquidity flows that are currently waiting on regulatory clarity actually begin to move, and the apparatus for that is being built right now, the math is not subtle. It is not a Moonboy fantasy. It is the logical, mathematical outcome of constrained supply meeting structurally expanding demand. Ask yourself this brutal question. At what price does a $7.5 trillion per day foreign exchange market function efficiently when its bridge asset has 55 billion circulating tokens, half of which are locked in cold storage? I'll let you do that math yourself. Now let's talk about what the institutions are actually doing, because this is where the signal becomes absolutely undeniable for anyone who is paying attention. First, ETF flows. The XRP ETF vehicles that are now live have seen consistent net inflows since launch. We have had days of outflows that you can count on one hand. Meanwhile, net accumulation continues. These are not retail buyers clicking buttons on Coinbase. These are capital allocators, wealth managers, registered investment advisors, family offices, who are taking a regulated, structured position in XRP through a compliant vehicle. That is not speculation, that is positioning. Second, Ripple's acquisitions. Does a company that is executing on a speculative narrative spend real money acquiring Hidden Road, one of the largest prime brokers in institutional crypto finance? Does a company that is hoping for the best acquire infrastructure that plugs its technology directly into the clearing and settlement rails used by hedge funds and institutional traders? Absolutely not. Ripple is not making these moves because someone has a good feeling. They are making these moves because the legal and regulatory pathway is clear enough that billion-dollar capital allocation decisions are being made with confidence. Third, the DTCC. I want to come back to this because I don't think people understand the gravity of it. The Depository Trust and Clearing Corporation is not a startup. It is not a blockchain enthusiast. It is the institution that clears and settles trillions of dollars in securities transactions every single day. It is the backbone of the American capital market system. When the DTCC publishes patents that reference digital liquidity tokens and hierarchical wallet infrastructure with XRP explicitly cited in the documentation, that is not coincidence. Patent filings are not filed on speculation. They are filed on intention. The DTCC is planning for a world in which digital assets are part of the clearing and settlement infrastructure of American finance, and they are filing intellectual property to stake their position in that world. Think about the magnitude of that signal for a moment. Fourth, the regulatory environment. We now have clearer legislative frameworks being constructed for digital assets than at any point in history. The Digital Asset Clarity Act and related legislation represent a fundamental shift, from regulatory ambiguity that kept institutional capital on the sidelines to a structured framework that gives legal certainty to asset classification, custody, and settlement. And remember this, Ripple spent years in legal battle with the SEC and emerged with a framework that no other project in this space has navigated. That experience, that legal clarity, that precedent, it is a moat. It is a competitive advantage that cannot be replicated by writing code. Ask yourself this, does a trillion-dollar asset manager like BlackRock or Fidelity or Franklin Templeton move capital without absolute legal certainty? They do not gamble. They do not speculate. They position. And the positioning that is happening right now in ETFs, in custody solutions, in clearing infrastructure, all of it is pointing in the same direction. While retail investors are watching candlestick charts and asking why the price isn't moving today, the institutional infrastructure is being locked in. The rails are being welded into place. So when does this move from infrastructure construction to price realization? Let me give you the timeline that matters. Not in terms of specific price targets, because that is not what this channel does, but in terms of the structural events that remove the remaining friction between here and there. 2025, Regulatory Clarity Confirmation. The legislative frameworks that are currently moving through Congress represent the final green light for the largest pools of institutional capital. When the Digital Asset Clarity Act, or its equivalent, is signed into law, the wait-and-see capital, which is measured in the hundreds of billions, becomes all-in capital. The risk premium embedded in every digital asset price right now is a regulatory risk premium. When that risk is legislated away, it does not gradually reduce. It vanishes. The price gap closes rapidly. 2026. Tokenization infrastructure goes live. We are in the construction phase right now. The DTCC patents, the EU digital product passport mandates, the FedEx supply chain digitization, the Ripple infrastructure acquisitions, these are blueprints. By 2026, the first of these systems go live at scale. When real institutional capital begins flowing through XRP rails in a live, regulated environment, not a pilot, not a proof of concept, but operational infrastructure, the on-chain data will show it, and the market will reprice accordingly. 2027, the EU mandate deadline. The European Union has set 2027 as the hard deadline for digital product passports on every item sold into its market. This is not a suggestion. It is a regulatory requirement with legal enforcement. The scramble to comply will drive enterprise adoption of on-chain infrastructure at a scale we have not seen before. The companies building that infrastructure are building it now. The settlement layer underneath it is being selected now. Here's the key insight. The catalyst timeline is not driven by crypto-native events. It is driven by regulatory mandates, enterprise compliance requirements, and institutional capital deployment cycles. These are not emotional. They are not subject to market sentiment. They are scheduled. The fuse is lit. The question is only whether you are positioned before the ignition point or after it. We are moving from an era of abundance to an era of scarcity, and I want you to understand exactly what I mean by that. Right now, you can buy XRP at a price that reflects a market that is still pricing in regulatory uncertainty, institutional hesitation, and retail impatience. That mispricing is a window, and windows close. Here's the supply picture. Exchange reserves are declining. When on-chain forensic data shows that tokens are leaving exchanges and moving into cold custody at an accelerating rate, that is not a neutral signal. That is the market structure changing underneath you. The tokens leaving Coinbase, leaving Kraken, leaving Binance, they are not going to wallets that sell at the next green candle. They are going to institutional custodians. They are going into multi-signature vaults. They are being collateralized, locked, and structured into financial products. Once a token enters that pipeline, it does not return to the spot market for a 10% profit. It is gone, not permanently, but gone on the timescale that matters for retail price discovery. Think about what that means mathematically. If circulating supply effectively shrinks, not because tokens are burned, but because they are institutionally locked, and demand continues to increase through ETF inflows, regulatory-driven enterprise adoption, and cross-border settlement growth, then the price of the remaining liquid supply is not just going up. It is being repriced against an entirely different demand curve. The concept of being able to buy a whole XRP at current prices will, at some point, be a story that older holders tell. Not because of hype, not because of a tweet, because of the structural mathematics of constrained supply meeting institutionally driven demand. The institutions have spent years, creating conditions that shook weak hands out of their positions. FUD cycles, legal uncertainty, prolonged sideways price action. The bear market was not random. The accumulation that happened during it was not random. And the people who held through it, who understood the thesis, who did not panic sell their position to whoever was buying on the other side, those are the people who will look back at this moment as the clearest decision they ever made. The door is closing, not slammed, closing. There is still time, but not unlimited time. I know it is hard to watch the market right now. I know that sitting in a position while other assets get news cycles and price action creates doubt. I know the headlines don't always cooperate with the thesis. But here's what I am trained to do. Distinguish between noise and signal. The noise is price action on any given day, week, or month. The noise is whether a competitor asset had a good Tuesday. The noise is the sentiment data, the social media volume, the fear and greed index. The signal is the DTCC filing patents. The signal is FedEx joining infrastructure councils focused on trusted digital settlement. The signal is the EU mandating on-chain product provenance at a continental scale by 2027. The signal is Ripple acquiring prime brokerage infrastructure. The signal is ETF vehicles live and accumulating consistently. Being early feels exactly like being wrong, right up until the moment reality catches up to the thesis. I want to be direct with you. There will be more moments between now and the catalysts I outlined where the price does not reflect the fundamentals. There will be more FUD. There will be more voices telling you this is over, that XRP is irrelevant, that the moment has passed. That noise has a function. Its function is to separate you from your position so that someone else can take it at your exit price and hold it to their entry point at the next level. The question is not whether XRP will be repriced to reflect global settlement infrastructure. The math makes that answer self-evident. The question is, who is still holding when that repricing happens? You have been doing the work. You have been paying attention when the room is quiet. You understand the structure. That understanding is not nothing. That understanding is everything in a market designed to reward the patient and punish the impatient. Stay with the signal. Let me leave you with this. Every civilization level shift in financial infrastructure has had a moment, a quiet moment, before the mainstream understood what was happening, where the architecture was being laid and the price had not yet caught up to the reality. We are in that moment right now. FedEx is talking about trust at the speed of data. The DTCC is filing patents on digital liquidity infrastructure. The EU is mandating on-chain provenance by 2027. Institutional ETF vehicles are accumulating consistently. Ripple is acquiring prime brokerage rails. Price is a distraction. Structure is the reality. The question is not whether this is happening. The question is whether you are watching the noise or watching the structure. If this analysis gives you value, do one thing. Subscribe and hit the notification bell. I am going to keep bringing you the signal when everyone else is chasing the noise. I am the calm analyst. The math doesn't lie, and the structure is almost complete. Stay patient, stay rational. We don't wait for the future, we plan for it.